What's going on, guys? How you guys doing? Today I'm gonna do something a little different, and I want to talk to you guys about stocks, particularly long-term investing. I'm a long-term investor. I'm more of an active long-term investor, to where I'm day to day dealing with my stocks and making decisions on, if I'm adding more shares or taking out more shares or applying new companies to my portfolio. I'm not so much of a long-term investor to where I put money in my portfolio or into stocks and then, I just look away and just come back a year later. So I'm very much active with my portfolio and with my investing. So I wanted to talk to you guys about my principles to, how I invest and what do I look for in order to make these kind of decisions on where I choose to put my money. There's a few principles that I have, that are, I guess you would call laws. I always go by these laws. They're a foundation of mine, so I don't go away from them that often. I pretty much always stick by these laws. I may add some, a few outliers based off of the company. Every company is different. So a few things may change in how I look at the company or how I approach my investing strategies with that company. But generally, my principles I stick with. And that's what I think that everybody should create. They should create their own set of principles or their own set of guidelines into how they invest in companies that, they may like. So with my long-term investing, I kind of break it up in two parts. I have a current future, which I like to call a current future, which is from, maybe 1 to 2 years. And I have another section that I call a true future, which is more, three plus. So 3 to 10 to 20 years. Those are a different set of companies. And the approach to how I select these companies are somewhat the same, only a few things may differ. And what may differ is, maybe the balance sheet or just the financials in general. A company that I'm looking at, currently, for that 1 to 2 years, I may not look so hard into its financials. It's more of a reaction because I see something that's going to have an immediate impact on this company. So I know that the shares, the stocks may benefit, immediately. Versus when I'm looking at a company that's 3+ years out, I may look at the financials a little bit more in depth. I may try to see, what kind of revenues that company has been bringing in year over year. If there's been a good amount of growth, are they profitable? Are they profitable yet? Do they have cash on hand? How much cash on hand? What are their liabilities? How much are they in debt? And, just from that standpoint, with those kind of companies, I will look a little bit harder to make my decision. For an example, I'll give you guys an example for a current future company that I may invest in for, long term, but not too long. Like I said, that 1 to 2 years, it would be maybe something like, the Cheesecake Factory. So there's an immediate effect on that company. There's a change in the environment that's happening immediately, and I need to make a decision right now. So I know because of C-19 that a lot of restaurants are going to struggle with business. A lot of retail spots are going to struggle, with getting customers to come in because now the government's putting protocols in place for us to socially distance ourselves from one another. So I see COVID back in February. It hadn't really hit the US yet. It didn't hit the US until late February, early March. And I saw how it was affecting other countries. So I get to thinking to myself, and I look at these other countries and how they're operating. Things are closing down. People are staying inside doors. So immediately, right away, I'm thinking, when it gets here, what companies are going to be affected by this? Who's going to hurt the most? So I break it down into categories. And this is, really how I make decisions. I break it down into who are going to be the winners and who are going to be the losers. But within that loser category, who is going to be able to bounce back and who won't be able to bounce back? So you got to figure out what companies, based off of looking at their financials of who you think can stick through something like this, who is going to be able to have enough cash on hand, or companies that are not so much in debt that I'm going to be able to, invest in them and they're still going to survive after this pandemic. You have to recognize those companies. You have to do your due diligence. But also, you have to figure out what companies aren't going to bounce back, because you may be holding one of those companies in your portfolio, and you need to figure out if you need to, get rid of that company. You need to know if you need to sell your shares, because this company is most likely not going to bounce back based off of their financials. When I notice something that's having a direct effect on the economy, I try to right away figure out how is this going to affect me and everyone around me, and I make decisions on investing based off of that. And I break those down into winners and losers, just repeating, so you guys get an understanding of how I actually go about this. So I break those down into winners and losers. Who are going to be the winners and who are going to be the losers? And within that loser category, I figure out who's going to be able to survive and who's not going to be able to survive. So I knew that Cheesecake, based off of their financials, they were a company that was, looking good financially, from a financial point of view. So I knew they would be a company that would bounce back from this. So when all the stocks, hit rock bottom back in, mid to late March, I started buying into Cheesecake Factory. I started buying into these companies that I knew were going to survive the pandemic. And it would just take a little bit of time before I saw my money to come back, but it shot up like a rocket. It came back. My money came faster than I thought it would. So, I look at it from that point of view, and, figuring out who the winners are going to be. Okay, people in Italy, people over in China, they're having to socially distance. They can't come outside. China's literally forcing people to stay inside. So how do I look at that? How is this going to benefit me? What companies are going to be successful off of something like this? Maybe not extreme as how it was in China, but we're going to have something of the similar effect, something to where, people can't come out, or there's curfew or something like that, no direct contact. So what companies are going to thrive the best under those type of circumstances? You look at Zoom. Zoom is a company that profited off of this pandemic because, pandemic forced people to socially distance themselves from one another, so no actual physical contact. So that means companies that were going to allow us to connect with one another without having to have physical contact are companies that are going to thrive. So you just got to be, somewhat of a visionary. At the end of the day, to be a long-term investor, you have to be a visionary. You have to see where trends are currently and where those trends are going to move. You got to be ahead of the curve. And you want to be ahead of the curve because you want to be able to beat these hedge funds. You want to be able to beat these, financial institutions. You want to get into plays before they realize that those are winning plays. Because once they realize that they're winning plays, your bag is going to pump because you've been in it already. You've already known that these are winners. These are winning companies in this scenario. So you always got to be thinking ahead. You always got to be ahead of the game and trying to understand where society is shifting. That goes for, current future companies and also, true future companies that are 3+. Now, when you find your winners, when you find the companies that you really want to invest in, you got to think of like which ones, who are going to be the market leaders, who are the ones that are going to, profit from this the most, directly and indirectly. So let's say the EV market, electric vehicles. There's Tesla, there's NIO, there's the actual companies that are building electric cars, but that isn't a direct effect, but indirectly, there's companies that are gonna be huge because of the demand of electric vehicles. So that means you should start looking at companies that are building batteries, companies that are mining, resources, that are mining rare earth materials, things like that are going to be needed, lithium, nickel, things that are going to be needed for these batteries, for these electric vehicles. So those kind of companies are called the picks and shovels. Those are companies that are indirectly affected by the need for the electric vehicles. because in order to have the electric vehicles need these other items. So those other item profit margins are going to go up because their production is ramping up along with the ramp up of production of electric vehicles. So you got to look at companies that are going to, indirectly benefit from circumstances or situations like for C19, we need a vaccine. So yes, I could invest in Pfizer, I could invest in Moderna, the companies that are making these vaccines, but I can also invest in companies that are indirectly affected by the production of these vaccines. And that would be CVS, that would be Walgreens, because these are companies that have to actually sell the products. So these companies are making a profit off of selling the vaccine, but along with that, people are walking into their store. So people are more inclined to shop around Walgreens or shop around inside of CVS. Okay, they may get their vaccine, but hey, I see some candy over there. Or hey, I'm thirsty, I want to go get a pop or soda, whatever you guys want to call it. Or I want some chips. So there are going to be other things that people are buying when they walk inside these retail places to buy the vaccine. So you're going to see an increase in sales. You're going to see, a higher earnings per share for these companies during earning calls. So CVS and Walgreens are going to indirectly benefit from the production of these vaccines. So that's how you got to look at it when you're making these kind of decisions on who you want to invest in, who's going to benefit directly and who's going to benefit indirectly. Now, you may ask me, why long-term investing? It isn't as sexy as day trading or swing trading, to where you can get those quick gains. You hear about these stories of people taking $5,000 and turning it into $50,000. That sounds so much more attractive, right? Doesn't it? The thing is that most people that trade that way often lose money. So yes, there may be times where you make money, you get lucky, you make money, you're able to get in and get out of a trade before, you get caught holding the bag, which means, losing money, losing your investment. But more often you're going to be losing money. More often that you're going to be stuck in plays where you're losing, $300 or you're losing $400 or you're losing thousands of dollars. So most of the time, you're going to be losing than you are winning. That's more of like a gambling game. And we want to be investing as if we're a business. We don't want to be playing the game. We don't want to be acting like this is the stock. It is the stock market. We don't want to be acting like this is the casino. We don't want to be just throwing money in without doing any type of due diligence for the company or knowing anything about the company in hopes of getting 10x your money. So we got to treat it like a business, and we got to treat it as if we lose our money, we're failing, we're going out of business. I might be up for bankruptcy. That's how you have to approach each investment. That's how I approach each investment. I approach it like a business, like as if I'm Coke and I'm acquiring, another business. How is this business going to affect my bottom line? Is this business going to be, a pain in my side, or is this business going to contribute to my profitability, my profit margins? So you want to approach investing in a sense of being a business instead of, as a game of hoping, I'm gonna ride the hype. Everybody's investing in this company, allowing the news and the media to pump up this company. Everybody's loving it, so I'm gonna throw money in while it's going up. So that's the wrong way of investing. You don't want to be investing in companies that are pumping. By the time it's pumping, you're really too late. You have no idea how that company is going to move, how that stock is going to move. You can put your money in and there could be a tremendous pullback and you lose most of your money off of making an irrational decision. You don't want to be buying stocks on days that they're pumping. You want to be buying on red days. I had a talk with, a gentleman the other day, and he was talking about, everything's down in the market. I don't want to spend my money on anything. And I'm like, this is the perfect day to buy something. This is when you buy something. It's like on discount. When you go shopping at, the mall, or you go shopping at Macy's or something, you don't buy when the items are at full price. You wait for the sales. You wait for Black Friday. You wait for Memorial Day. You wait for, A few days after Christmas, you buy when things are on sale. And that's how you got to look at the stock market. You want to buy when things are in the red, when there's a major pullback, or when there's a pullback, and you think the price that it's at, justifies your reason for investing in it. Those are the days that you want to buy. So that's why I try to teach people to not fear red days, but embrace them and love red days. So back to the reason why I prefer long-term investing is because only about 20% of people that put their money in the stock market are around for a year. And out of that 20%, only 10% are around for more than 5 years. So most people are getting in and out of the stock market. They're not ever really allowing their money to pump for them and to make real gains for them. Even if you don't know how to trade, if you keep your money in the market long enough, I would say 10 years is ideal. You would beat most traders because most traders blow up their account and give their money back. They either give all their money back or most of it because they're too busy trying to swing trade, day trade, or they just have no clue what they're doing and they get scared and they pull their money out. Or because there's an economic downturn, they see, a short-term loss on their portfolio, they get scared and pull their money out and solidify those losses versus, sticking through it and just learning to hold. These companies will bounce back, even in downturns where it seems like, it can only get worse. Most of the time, it'll get better. Recessions happen about every, 10 years. So there's one that's bound to come, but only the strong survive. You got to be willing to, get in those kind of plays, have an economic downturn and hold those plays. And if you do anything, you buy more. We buy on dips. That's what we call, that's what I like to say. We buy on dips. When things are down, we buy more. So I'm not going to sell mines during a recession. I may see a negative, couple $1,000s on my account, or, maybe double figures, triple figure loss on my account. But that doesn't worry me. I know to buy more. I'm going to buy more of companies that I believe in. I believe in Tesla. I believe Tesla is going to survive and is going to really change the world. So if I see a major pullback in Tesla, I'm going to buy more because once that economy turns around, it's going to shoot to the ceiling. And when I buy more on the dip, I'm bringing my average cost down. I'm dollar cost averaging. So I'm buying on dips. So my cost average before may have been 287, but now I'm buying on that dip. Now my cost average is down to 100. So when that stock shoots back up, I'm more in the green. I'm creating more profitability for myself. So you got to want to hold. You got to be able to hold. You got to be strong about holding and be strong about not being psyched out when you see red days, because the stock market does nothing but go up in value. It does nothing but go up. There may be years where there be pullbacks, but over time, the stock market goes up. So that's why I say if you hold your money for at least 10 years, if you can hold it for longer, 20, 30, 40 years, that's just incredible. But if you were to just hold your money into some safe bets, into some safe companies in the stock market, it's going to go up over time. So if you do nothing, if you add nothing, you're going to see a great increase on your face value just because of the natural state of the stock market always going up. The way I invest is I only buy growing companies. Those are the only type of companies that I'm interested in, is buying growing companies and holding. If I can give anybody some decent advice, it would be to buy growing companies and hold them. You look at these companies like Apple, Amazon, Tesla. These are companies that are going to change the way we interact as a society. They're going to change the way we do things. They're going to change the way we live. So though Apple may be a $2 trillion market company, it is still growing. It's still a growing company. And you're going to see, the ramifications of that if you just buy and hold. And if you do nothing else, you're going to see major growth in your portfolio. And these fundamentals are tried and true. This isn't something that, I'm just making up. You can go look at the statistics. You can see that the stock market goes up. It naturally goes up. This isn't, this isn't fake news, what Trump likes to say. This is just facts. It's factual. I really recommend that, people invest in a long-term point of view and leave that day trading and swing trading. Maybe swing trade a little bit. You can swing trade a little bit. I swing trade here and there. I may ride momentum of companies for a little bit, but I'm not particularly fully sold on that company for the long future. So I wouldn't be looking at them as a long-term investment. But swing trade, which is different from day trading. Day trading is way, way more volatile, and you're way more likely to lose your money day trading. Swing trade, hold a company for a few days, ride its momentum, and then put a stop loss, or put some type of trailing stop order to where if your stock goes down to this number, then it'll sell all your shares, or a trailing stop loss to where you ride that momentum, and if it ever pulls back, 10-15% based off of whatever you set it as, it'll sell all your shares. So that's just ways of protecting yourself. That's protecting yourself so that you don't lose all the profits that you have gained. But yeah, this is pretty good video. I think I'm gonna do a part 2. I want to go a little deeper in some other things, so I'm gonna be hitting you guys with that video soon. But thank you guys for checking this out, and I'll catch you guys in the next one. I'm out.